This video will provide a walkthrough to the solution for exercise 13.1, which focuses on accounting for convertible bonds under both IFRS and ASPE. Here's the data for our problem. On January 1st, 2025, Large S Limited issued 1,000 4-year 6% convertible bonds at par of $1,000. Interest is payable each December 31st. Each bond is convertible into 100 common shares, and the current fair value of each common share is $7 per share. Similar non-convertible bonds carry an interest rate of 8%. We have 3 requirements for this problem. The first is to calculate the present value of the debt component, and then to record the bond issuance if Large S follows either IFRS or ASPE. So let's begin with requirement A, where we are to calculate the present value of the debt component. First, it's important to understand that convertible bonds are actually comprised of 2 components. There's a debt component, which is the value of the bond exclusive of the conversion feature, and then there's the equity component, which represents the embedded or attached option to convert the debt into common shares. The debt component is simply the present value of the bond calculated using an appropriate market yield. So using our calculator, entering the values from left to right, we'll enter 4N because this is a 4-year bond. For the interest rate, we're going to use the 8% market rate, which is the rate that non-convertible bonds would yield in the market. We'll enter 60,000 per PMT, that's $1 million face value or par value times a 6% coupon, and then 1 million FV, and compute PV to be 933,757. For requirement B, let's record the bond issuance if Large S follows IFRS. We'll start with the easy item, and on January 1st, the company will receive $1 million in cash because the bonds were issued at par. Next, we'll credit the bond payable for the present value of the bonds or the debt component for $933,757. And the balance, or the residual, is the difference between the proceeds at par and the present value of the debt component alone, which is $66,243 in this case, and that's the incremental value of the option. So the company will credit contributed surplus for convertible bond options for the residual or remaining amount of $66,243. Our last requirement, C, is to record the bond issuance if the company follows ASPE. Under ASPE, there are 2 alternatives or options that the company can choose from to account for convertible bonds. The first option is known as the zero equity method. In this case, there is no amount attributed to the convertible bonds, i.e. there's no equity component. So the company will debit cash for $1 million and credit bonds payable for the full amount of the bonds because they're received at par. The other option under ASPE is the residual method, which is the same as we just saw under IFRS. So the company will debit cash for $1 million, credit the bond payable for the present value of the bond using a market yield of 8% for non-convertible bonds for $933,757, and the difference to contributed surplus for convertible bonds of $66,243. And that's it. We're done this problem.